Hello investors. So Kaynes Technology has fallen quite a lot recently and many investors are stuck in it. So today we will talk about Kaynes, what problems are recently going on here and how its future looks like. But before we begin, as a very strict standard disclaimer, this video is not a buy or sell recommendation on Kaynes in any way. Please keep that in mind. With that, let's get started. So the problems for Kaynes began when Kotak released a report stating that there were accounting mismatches and reporting issues in the company. Since then, Kaynes has been correcting significantly. Ideally, such corporate governance issues or accounting lapses should not happen in such a large business. But now that they have happened, there is no point in going all over that again. We will not focus on what has already happened. But here, one thing you need to understand is when such reporting issues happen, the market may tolerate slightly. That is fine. But not when a business is trading at such a high and premium valuation. Keynes has always traded at premium valuation. If you look at it, it used to trade at a PE of around 140, 150. But when any business trades at such a high premium PE, the market expects perfection from it. There will be consistency. The market expects consistency, that growth rates will be maintained and there will be no surprises. But when these issues came up at Keynes, the market reacted very negatively. This is called PE derating. Keynes has now fallen from a PE of 150 to around 60, 65. So if you ask me whether the market will give Keynes a PE of 100, 150 again, I don't think so. Because at that time, there was a different trend and a lot of optimism was around the business. There was a lot of hype. But now the market is pricing many different concerns as well. Now, humble request, just before moving forward, if you are liking this video so far, do give me a thumbs up. Also, you can subscribe to our channel Simpli Stocks, where we bring multiple such videos every week. Honestly, your likes and subscribes are our only motivation so that we keep bringing such high quality research to you for free. So do like this video and yes, also subscribe to our channel. Along with all this, Keynes is also facing working capital and cash flow problems. They provide electronic manufacturing services across different sectors, and smart meters is a fairly large segment of their business. The way smart meter sector works is that once you manufacture the product and install it, there is also maintenance work associated with it for around 7 to 10 years. Because of this model, the revenue recognition remains bifurcated. Some revenue is booked immediately while the rest gets deferred for the coming years, where you may have to supply spare parts or say handle maintenance. So Keynes supplied the smart meters, but payments for that work will take time. This is where working capital or cash flow issues are now popping up, which earlier the market used to ignore. However, now the company is also trying to fix this by focusing on bill discounting. They are also in talks with their clients to move away from this service heavy model and limit themselves primarily to product development. But smart metering C is just one part of the working capital issues. Some of their other customers are also delaying payments and companies facing difficulty in recovering that money. That is why you can see how working capital days and receivable days have increased to around 139, 140 days. There is also some contribution from inventory buildup for Q4 here, because as the March quarter is a big quarter for them, they buy raw materials in advance to ensure timely production. But even if you set that aside, the working capital issues still remain. Here, if I summarize, the first problem was around accounting lapses, reporting issues, and corporate governance concerns. After that, working capital issues appeared. Now, apart from this, there has been a slowdown in the business. Along with smart metering, Kavach is also an important segment for Keynes, and work has been delayed in this segment. Management says that they are taking more time to improve the product and they will ship it next year. But more or less, what we can see is that work has been delayed. Because of this, Q3 results were dull and they have also reduced their sales target for this year. So that is another concern. And this is not the first time it has happened. Last year as well, management had revised their guidance downward. They initially had a 3,000 crore sales target, which they reduced to 2,700 crore. This year's initial guidance was 4,400 crore in sales, which has now been reduced to around 4,000, 4,100 crore. The market may ignore such things once or twice, but if the same pattern continues over the time, company stops receiving such premium valuations, because essentially what happens is that when you reduce your sales guidance, the growth rate of the business also decreases. And now with Keynes, this slowdown risk will remain going forward as well. Keynes faces this risk because clients sometimes delay orders from their end. You can think of it this way. Suppose Keynes is doing EMS work for a medical equipment company. If that client faces production issues or their operations slow down, they may delay purchase orders from their side. If they do not procure PCBs from Keynes, then Keynes sales will take a hit. Another issue is that end users sometimes reschedule orders too. Now, look at it this way in the context of Q4 and war related disruptions. Keynes does not generate a large portion of its revenue directly from exports. That is fine. But if their customers are export oriented businesses, or if they rely on imported parts for their manufacturing and war leads to supply chain disruptions, their production will halt. In that case, there will be slowdown in those companies, in the clients, and then the clients will delay orders. So this risk can play out because around 40% of Keynes business comes in Q4. As of now, management has kept their 4,000 crore sales target intact for this year. But if supply chain issues appear in the March quarter, which is their biggest quarter, then they may also have difficulty in achieving revised target that they have given. And over time, I have observed that management's tone or say narrative has also changed. The focus has shifted towards the order book. They say that their order book is growing at around 50%. For sales, I think they have given an estimate of roughly $1 billion in revenue after 2 years, which translates into about 40 to 45% sales growth. And although the order book is currently growing at 50%, but there are hints that sales growth will lag behind the order book growth. So now you have to closely monitor both order book growth and also execution. The company is adding more capacity, that is fine. So in terms of opportunity, the business looks good. But right now, there is significant execution risk in Keynes, which we are looking at. At the moment, you are getting a 40-45% type growth business at a PE of around 60-65. From an EMS industry or semiconductor stock perspective, it might look attractive after such a correction. But there are, I think, too many ifs and buts. If you ask me, I am not able to see enough clarity or consistency in the business right now. At a PE of 60-65, you can find better businesses where you do not have to deal with so many issues, whether related to cash flow or corporate governance. And now, because end user problems, we may also see war related disruptions or risk playing out. So we can say that even after so much correction, 60-65 PE is still not a cheap evaluation. You can't expect extraordinary upside from here given all these circumstances. Now, if you found this video interesting and you did not like the video earlier, then please do so now, and also subscribe to our channel. If you support us with your likes and subscribes, it will motivate us to bring you more such high quality analysis every week. So please like this video, and yes, also subscribe to our channel. I will meet you in the next video. Happy investing.